Okay, on foreign exchange, when we're doing FRQs, make sure that we're going to answer all of our FRQs in kind of the same form that they've been given to us in the questions. So you got 3A, then I, then 2I, and B and C, and so on. Okay, this is one I just kind of scratched on a little bit, but I'm going to do, and remember, I always encourage kind of think your way through everything, and I'll walk you through this part. Okay, so 2015, number 3, foreign exchange FRQ. So 3, and we're going to have A. So the first thing it says, exchange rates and interest rates are important for macroeconomic decision making. Yes, we know that. Okay. Now, let's see if this helps. And not really. Okay. Exchange rates and interest rates. Oh, sorry. Whoops. Okay. How does an increase in Japan's government budget deficit affect each of the following? Okay. Anytime I see something like that, that is very important. Okay. It's an increase in their government budget deficit. Okay, deficit means they don't have any money, right? So now they're going to increase that deficit even more. So that means they're going to spend even more money than they have. Now, question is, where do they get the money from? Well, they're going to get it from the loanable funds market, if you remember from a few lessons ago. Okay, so the demand for loanable funds is going to go up, and that means it's going to be crowding out. So anytime there's crowding out, they're either going to draw out of the supply of loanable funds, which is the money you and I put into the bank, or they're going to demand loanable funds. And that, of course, is going to drive the interest rate up, because interest is the price of borrowing. So they're asking you, what does the real interest rate in the short run in Japan do? And explain. Okay, well, my explanation is going to be that the real interest rate is going to increase. Now, of course, it says explain, so my explanation is that whenever they have we get a point for saying that the real interest rate will rise in the short run, okay? And that's going to be because the supply of loanable funds is going to decrease, or the demand for loanable funds is going to increase. And that's all you really have to say is why. And you can abbreviate like this a little bit. If you're not comfortable yet doing that, you can always write it out, of course. Okay? So now, what they also ask in the question is, what's going to happen to private domestic investment in plant and equipment in Japan? Well, investment is going to decrease. Remember, that's gross private investment, because that makes people not want to borrow at high interest rates. And they don't say to explain that part, but just saying plant and equipment is going to decrease. So gross private investment is going to decrease. All right, so now there's part B. It says, draw a correctly labeled graph of the foreign exchange market for the euro and show the effect of the change in the real interest rate in Japan from part A on each of the following. Okay, so now I got my part B, and it says correctly labeled graph. So what they mean by that is that they're not going to give you points unless this is labeled all correctly. So, and always check back on here. Say it's going to be for the euro. So now I know that the euro is going to be the market that I'm looking at. Remember, it's kind of a C with two lines through it. Okay, so you've got the supply of the euro, the demand of the euro, the quantity of the euro, and of course this is going to be our yen over the euro. Just remember, whatever symbol or currency it is, that goes underneath everything on here. Okay, so and we have our quantity, then of course we've got our exchange rate, or whatever they tell you to label it. All right, so now, look at our question again. Foreign exchange market for the euro, show the effect of the change in the real interest rate on each of the following. What's going to happen to the supply of the euro? Okay, so we got Japan and the euro, and in this question you have to assume that they're trading partners because they're the only two countries in this, and it's a global economy. So now, what I'm thinking right now is people in euro, I just put euros, they want yen to buy high real interest rate assets in Japan. So in Japan, what happened is their interest rates went up because of the deficit spending. If interest rates are high and I live in Europe, I'm going to need those Japanese yen because I want their assets. I can put my money in their savings accounts, their bonds, or whatever financial assets, because they're going to pay more interest. That's going to get me to put my money over there. So what's going to happen? Remember, I have to put my euros back into the supply. That's the supply of euros is going to increase. Okay, so I got to put my euros back in the supply before I can demand the yen. Remember, go to the bank, and then that's how exchange works. So what's going to happen here is that is going to drive that. We can call it the price, the yen price of the euro, or the exchange rate, or whatever. Okay. Now, supply of euros, and now explain. So my explanation is I draw my graph, then I show the supply curve shifting to the right. Then I need to explain that the European purchase of Japanese financial assets will increase due to the high rate of return in Japan. So my explanation, and it's in these two parts. Remember, that's my graph, and that's what's going to happen to it. Okay, so this was I. Then my explanation is going to be that European purchases, sorry, my handwriting is really bad, of Japan's financial assets will increase because of the high real interest rate. Oh, whoops, sorry about that. Because of the high real interest rate. All right, so hopefully that helps explain that part. Now, the other country has to balance this out a bit. To reverse the change in yen price of the euro identified in Part B, 2, should the European Central Bank buy or sell euros on the foreign exchange market? So I'm thinking this out a little bit. So the European Central Bank can buy euros to lower the money supply and raise interest rates back up. So that's another way. You've got buy bonds, sell bonds. You also can buy currency. So when they choose to do this, we're going to say that the European Central Bank should buy euros. Okay? They don't say on here to explain, so we don't have to. But in my mind, I'm thinking, if I make the money supply smaller, that makes interest rates go up. And that would counteract having the high interest rates in Japan in Europe. So Europe's high interest rates would make people want to either leave their money and keep it in those investments or whatnot. All right, so that's one of the FRQs. Hope that explains a lot.